Ask most people to define investment risk, and they'll say something about losing money or volatility or uncertainty. Ask them what a risky investment looks like, and they'll point to small companies, emerging markets, or cryptocurrencies. Ask them how to reduce risk, and they'll talk about diversification or buying stable blue chip stocks. These answers sound reasonable, but they are fundamentally incomplete and sometimes completely wrong. This is the problem. Most investors don't actually understand what risk is, and this misunderstanding costs them dearly over their lifetimes. Here's the uncomfortable truth. The way most people think about risk almost guarantees mediocre results or outright failure. They confuse volatility with risk. They confuse unfamiliarity with danger. They confuse safety with avoiding short-term price fluctuations. And perhaps most damaging, they focus obsessively on the wrong risks while ignoring the risks that will actually determine their financial outcomes. Great investors think about risk completely differently. They have a more sophisticated, more useful, and more accurate framework for understanding what's actually dangerous and what only appears dangerous. This difference in thinking about risk is not a minor detail. It's often the primary factor that separates successful long-term investors from everyone else. Get risk wrong and nothing else matters. Get risk right and many other mistakes become survivable. Warren Buffett has said that risk comes from not knowing what you're doing. This is a radically different perspective from the conventional view that risk is inherent in certain assets or market conditions. It suggests that risk is personal, contextual, and controllable through knowledge and discipline rather than something you simply accept or avoid based on asset class labels. Charlie Munger approached risk through the lens of avoiding ruin. His framework was not about maximizing returns or accepting measured volatility. It was about structuring positions so that no single mistake or adverse event could destroy you. This seemingly defensive posture actually enabled more aggressive long-term wealth building because it ensured survival through inevitable difficulties. Understanding how great investors think about risk matters profoundly because it changes everything. It changes what you invest in, how you size positions, how you respond to volatility, how you evaluate opportunities, and how you structure your entire financial life. It's the difference between being paralyzed by fear of the wrong things and being rationally cautious about what actually matters. This video examines how successful investors think about risk differently from typical investors. We'll explore what risk actually is versus what it appears to be, why conventional risk metrics mislead more than they inform, how to distinguish between genuine dangers and false alarms, and most importantly, how to think about risk in a way that enables better decisions and better long-term outcomes. This is not about taking more risk or less risk. It's about understanding risk clearly enough to take the right risks while avoiding the wrong ones. To understand how great investors think about risk, we must first dismantle the conventional understanding and see why it's inadequate. The standard framework taught in finance courses and used by most professionals defines risk as volatility, typically measured by standard deviation of returns or beta relative to a benchmark. According to this view, assets that fluctuate more in price are riskier, and the goal is to build portfolios that balance return against this volatility-based risk. This framework is mathematically elegant and useful for certain purposes, but it's fundamentally flawed as a guide to actual investment risk. The problems are multiple and serious. First, volatility is not risk for long-term investors. If you own a quality business and its stock price fluctuates wildly, but you have no need to sell, the volatility is irrelevant to your outcomes. It's just noise. Your actual risk is whether the business deteriorates or whether you're forced to sell at a bad time, neither of which is captured by volatility measures. In fact, volatility often creates opportunity rather than risk if you have capital and the discipline to buy when others are panicking. Consider a specific example. Suppose you own stock in an excellent business with strong competitive advantages, good management, and solid fundamentals. Over the next year, the stock price drops 40% due to market panic about an economic recession. Standard risk metrics would say you experienced high risk and a large loss. But if the business fundamentals remain strong and you don't sell, you haven't lost anything permanent. The business is still generating value. When markets recover, the stock price will likely recover and exceed where it started. The volatility was not risk. It was noise that created a buying opportunity. Now contrast this with a different situation. You own stock in a mediocre business with no competitive advantages in a declining industry. The stock price is stable for years, exhibiting low volatility. Standard risk metrics would say this is a low-risk investment, but the business is slowly deteriorating. Competitors are taking market share. Technology is making the business model obsolete. Eventually, the business fails and the stock goes to zero. This was extremely risky despite low volatility because you faced permanent loss of capital. These examples illustrate that volatility and risk are different things, sometimes completely unrelated. Yet the entire conventional framework treats them as synonymous. This fundamental error leads investors to avoid the wrong things and embrace the wrong things. Second, the conventional framework ignores the most important risk: permanent loss of capital. This is the risk that actually matters. If you buy an asset for $100 and it temporarily drops to $60 but eventually recovers to $150, you experienced volatility but not permanent loss. If you buy an asset for $100 and it goes to zero because the underlying value was destroyed, you experienced permanent loss. These are completely different outcomes, but conventional risk metrics don't distinguish between them. Great investors are obsessed with avoiding permanent loss of capital. They structure everything around this goal. They analyze businesses to understand whether value can be permanently destroyed. They size positions so that even if they're wrong, they survive. They maintain margin of safety so that errors don't lead to ruin. They think constantly about what could cause irreversible damage versus what's just temporary fluctuation. Third, the conventional framework fails to account for the personal nature of risk. Risk is not the same for everyone. It depends on your time horizon, your liquidity needs, your knowledge, your psychological capacity, and your specific circumstances. An investment that's extremely risky for one person might be low risk for another. For example, concentrated positions in individual stocks are conventionally considered high risk due to lack of diversification. But if you deeply understand a business, have a long time horizon, and have the psychological capacity to tolerate volatility, a concentrated position might be lower risk for you than a diversified portfolio of businesses you don't understand. You're matching your approach to your knowledge and capacity, which is rational risk management. Conversely, what's conventionally safe might be risky given your circumstances. If you're young with decades until retirement and you keep everything in cash or bonds earning minimal returns, you face enormous risk that inflation will erode your purchasing power and you'll never accumulate enough wealth. The conventional safe allocation exposes you to long-term purchasing power risk that could be devastating. The conventional framework misses all of this nuance because it treats risk as an objective property of assets rather than as a relationship between assets, goals, knowledge, and circumstances. This is a fundamental category error that leads to poor decision-making. Let's explore what risk actually is from the perspective of great investors. This is not a simple substitution of one definition for another. It's a complete reframing that changes how you think about every decision. Risk, properly understood, is the probability and magnitude of adverse outcomes that actually matter to you. This sounds similar to conventional definitions, but the crucial differences are in what outcomes matter over what time frame and how you assess probability. For long-term investors, the outcomes that matter are permanent impairment of capital and failure to achieve financial goals, not short-term volatility. A year of poor returns is not an adverse outcome that matters if you have a 30-year time horizon. Permanent loss of capital or falling short of your retirement needs are adverse outcomes that matter enormously. This reframing changes everything. It means you're not worried about daily, monthly, or even yearly fluctuations in value. You're worried about things that could permanently damage your capital or prevent you from achieving your goals. This is a much narrower set of concerns, and identifying them requires different analysis than looking at volatility charts. What permanently impairs capital? Business failure, leverage that forces selling at wrong times, fraud or accounting manipulation, technological disruption that destroys business models, regulatory changes that eliminate profitability, buying businesses at prices so high that even good outcomes can't justify the valuation. These are real risks worthy of serious attention and analysis. What doesn't permanently impair capital? Market volatility, temporary business setbacks, short-term underperformance, other people's opinions about value, news events. Most of what dominates financial media and what most investors spend time worrying about is in this category. It's noise, not risk. The Great Investors Framework focuses analytical effort on the first category and largely ignores the second. This is radically different from typical investors who obsess over the second category and often miss the first entirely. Let's make this concrete with Warren Buffett's approach. When Buffett evaluates a business, he's not asking, what's the beta or what's the historical volatility? He's asking questions that relate to permanent capital impairment. Does this business have a durable competitive advantage that will protect its economics for decades? Is management honest and competent? Are the finances strong enough to survive difficult periods? Can I understand the business well enough to have conviction? Am I paying a price that provides margin of safety if I'm wrong about some assumptions? These questions are about fundamental risk, the risk of permanent loss. If the answers are favorable, Buffett is unconcerned about price volatility. He expects volatility. He knows the market will occasionally price the business at absurd levels, both high and low. This doesn't change the underlying risk profile. The business either has durable value or it doesn't. The capital is either likely to be permanently impaired or it's not. Price fluctuations are irrelevant to this assessment. This leads to what seems like a paradox. Great investors often see opportunity where others see risk, and risk where others see safety. When markets crash and volatility spikes, Conventional risk metrics flash red and suggest reducing exposure. Great investors see prices below value and understand that the actual risk has decreased because you're buying at better prices with higher margin of safety. When markets are calm and everyone feels safe, and conventional risk metrics look benign, but great investors see elevated valuations and reduced margin of safety, which means actual risk has increased. This is not contrarianism for its own sake. It's the logical result of focusing on actual risk rather than volatility. When prices fall below intrinsic value, you have less risk of permanent loss because you're buying at a discount. When prices rise far above intrinsic value, you have more risk of permanent loss because you have no margin for error. Volatility and fear are inversely correlated with actual risk in many situations. Understanding this reframing is essential. Risk is not volatility. Risk is not unfamiliarity. Risk is not what scares you emotionally. Risk is the probability and magnitude of permanent capital impairment or failure to achieve your goals. Everything else is commentary or noise. One of the most important concepts in how great investors think about risk is margin of safety. This idea, popularized by Benjamin Graham and central to value investing, is a practical tool for managing risk that works differently than conventional diversification-based approaches. Margin of safety means buying assets at prices significantly below your estimate of intrinsic value. The discount provides a buffer against errors in your analysis, adverse developments you didn't anticipate, or bad luck. If you estimate a business is worth $100 per share and you buy at $50, you have a 50% margin of safety. If your estimate is wrong and the business is only worth $75, you still make money. If adverse events reduce the value to $80, you still make money. The margin absorbs errors and bad luck. This is fundamentally different from managing risk through diversification alone. Diversification says own many things so that individual failures don't hurt too much. Margin of safety says own things at prices where even if you're wrong, you're unlikely to lose money. Both have value, but margin of safety addresses the quality of individual decisions rather than just spreading exposure. Great investors think constantly about margin of safety. It's not just about value investing. It applies to every investment decision in every aspect of financial life. When you're considering any investment, ask, what's my margin for error? If my assumptions are too optimistic, will I still be okay? If unexpected problems arise, will I survive? If I'm wrong about the time frame, can I wait longer? This questioning reveals true risk more clearly than any statistical measure. If you have substantial margin of safety, your actual risk is low, even if volatility metrics suggest otherwise. If you have no margin of safety, your risk is high, even if everything looks stable. Consider how this applies beyond stock investing. When you're deciding how much house to buy, margin of safety means buying well below what the bank says you can afford. The bank's calculation assumes everything goes perfectly. No job loss, no unexpected expenses, no income reduction, no interest rate changes if you have variable rate debt. Life rarely cooperates with perfect assumptions. Margin of safety means structuring your finances so that you can handle imperfect outcomes or consider career risk. Taking a job that pays well but requires skills you don't have and provides no learning or development is high risk despite seeming safe. You have no margin of safety. If the specific role disappears, you have no transferable value. Taking a job that pays less but develops valuable, transferable skills provides margin of safety. If the specific job disappears, you have options. This thinking, always asking about margin for error and downside protection, becomes habitual for great investors. They're not just asking what can go right, they're obsessively asking what can go wrong and can I survive it? This is not pessimism. This is rational risk management. The relationship between margin of safety and position sizing is important. If you have high conviction and substantial margin of safety, you can size a position larger. If you have less conviction or thinner margin of safety, you size smaller. This is how you match your portfolio structure to your actual risk assessment rather than following arbitrary diversification rules. Charlie Munger talked about the difference between sit on your ass investing and constant trading. The margin of safety concept enables sitting on your ass. When you buy at prices that provide substantial margin for error, you can hold through volatility and temporary setbacks because you have confidence that you're protected against permanent loss. Without margin of safety, every piece of bad news creates fear that you might have made a mistake, leading to panic selling and activity that destroys returns. Let's examine a crucial but often misunderstood aspect of risk: the difference between good risks and bad risks. Not all risk is created equal. Some risks are rationally acceptable because the potential reward justifies the probability and magnitude of loss. Other risks are irrational regardless of potential reward because they expose you to ruin or offer unfavorable odds. Great investors take plenty of risk. They don't avoid risk, but they're extraordinarily selective about which risks they take. They take risks where they have an edge, where the odds are in their favor, where they can survive being wrong, and where the potential reward is large relative to the risk. They avoid risks that could lead to ruin, where they have no edge, or where the odds are unfavorable regardless of the potential reward. What makes a risk good? First, you understand it. You can articulate what could go wrong, estimate probabilities, and evaluate whether the potential reward justifies the risk. If you don't understand what you're risking and why, it's automatically a bad risk even if it works out. Second, you can survive the downside. If the worst case would destroy you financially, it's a bad risk regardless of upside potential. The math of ruin is unforgiving. It doesn't matter if you make exceptional returns for years. If one bet destroys you, you're out of the game permanently. Third, the expected value is positive when you account for probabilities. If there's a 70% chance of making 20% and a 30% chance of losing 10%, the expected value is positive. You'll be wrong 30% of the time, but over many iterations, this is a good risk to take repeatedly. Fourth, the risk is uncorrelated with your other risks. Taking concentrated risk in your employer's stock when you also depend on that employer for income means you have double exposure. If the company fails, you lose both your job and your investment simultaneously. This is bad risk management, even if the stock itself seems attractive. What makes a risk bad? The opposite of the above, but also some specific patterns that great investors avoid religiously. Leverage is often a bad risk because it can force you to realize losses at exactly the wrong time. You might be right about an investment's long-term value, but if you're leveraged and the price drops, you get margin calls and must sell at the bottom. Leverage converts temporary volatility into permanent loss. This is why Charlie Munger often said there are 3 ways to go broke: liquor, ladies, and leverage. Investing in things you don't understand is always a bad risk. You cannot evaluate the probability of adverse outcomes if you don't understand the fundamentals. You're essentially gambling rather than investing. Sometimes gambling works out, but it's not a sustainable approach to wealth building. Taking risks where you're competing against much more knowledgeable or better resourced competitors is usually a bad risk. If you're trading against sophisticated hedge funds with better information and faster execution, the odds are stacked against you. You need an edge, and competing on their turf where they have every advantage is not an edge. Taking career or business risks that only work if everything goes perfectly is bad risk management. Things rarely go perfectly. If your plan requires no setbacks, no competition, no adverse luck, it's a bad plan. Good risks have multiple paths to success and can tolerate things going wrong. Great investors think carefully about which bucket each potential risk falls into. They don't avoid all risk, they avoid bad risks and actively seek good risks. This is completely different from conventional approaches that try to minimize risk generally or that take risk blindly in pursuit of returns. Let's make this concrete with examples. Starting a business in a field where you have deep expertise, industry relationships, and insight into customer needs is a good risk. You understand what you're doing. You have edge. You can afford to fail or iterate without being destroyed. The odds are uncertain but likely favorable given your edge. This is risk worth taking. Starting a business in a field you don't understand, with borrowed money, in a crowded competitive market where failure would ruin you financially, is a bad risk. You don't understand what you're doing. You have no edge. Leverage means you can't survive mistakes. The odds are unfavorable. Even if potential rewards are large, this is irrational risk-taking. Buying individual stocks in businesses you've researched extensively and understand deeply, at prices below intrinsic value, sized so that even total loss wouldn't devastate your portfolio, is a good risk if you have genuine edge. You understand it. You can survive being wrong. The odds are in your favor if you've done the work correctly. Buying stocks based on tips or momentum without understanding the businesses at any price is a bad risk. You don't understand what you're doing. You have no edge. You're competing against others who know more. The odds are unfavorable. This framework, distinguishing good risks from bad risks rather than high risk from low risk, is how great investors think. They're not risk averse, they're bad risk averse and good risk seeking. Now let's address one of the most misunderstood aspects of risk: the relationship between concentration and risk. Conventional wisdom says diversification reduces risk and concentration increases risk. Great investors understand this is incomplete and sometimes backwards. Diversification absolutely reduces certain types of risk, specifically the risk that any single position's failure destroys you. If you own one stock and it goes to zero, you've lost everything. If you own 20 stocks and one goes to zero, you've lost 5%. This is mathematically obvious and valuable, but diversification also reduces returns if you're forced to include mediocre ideas alongside good ideas. If you have 10 excellent investment ideas that you understand deeply and you dilute them by adding another 30 mediocre ideas just to hit some diversification target, you've reduced your expected returns significantly. You've traded the risk of concentrated positions for the risk of mediocre returns. Great investors recognize that for them, excessive diversification is often riskier than concentration. If you deeply understand 5 businesses and size positions appropriately, you likely have less risk than owning 50 businesses you don't understand. The conventional metrics will show the concentrated portfolio as higher risk, but the actual probability of permanent loss might be lower because you know what you own. Charlie Munger and Warren Buffett built massive wealth through concentrated positions in businesses they understood deeply. Berkshire Hathaway itself is highly concentrated, with major portions of value in just a few core holdings. This seems risky by conventional metrics, but is actually rational given their knowledge and conviction. The key insight is that concentration is only risky if you don't know what you're doing. If you do know what you're doing, concentration can reduce risk by allowing you to focus resources where you have the most edge and conviction. You're choosing to accept company-specific risk that you understand and can evaluate in exchange for avoiding the risk of mediocre returns from excessive diversification. This doesn't mean everyone should concentrate. It means you should match your diversification to your knowledge and capacity. If you don't have time or skill to deeply understand individual businesses, broad diversification through index funds is entirely appropriate. You're acknowledging your limitations and managing risk accordingly. That's rational. If you do have knowledge and conviction in specific ideas, some concentration is rational. The degree depends on your knowledge, your risk capacity, and your psychological ability to tolerate volatility in concentrated positions. What's irrational is either concentrating in things you don't understand or over-diversifying away edge you actually have just because conventional rules say you should own more positions. Both are failures to think clearly about your actual risk profile. Great investors also think differently about diversification across asset classes and geographies. They don't diversify just to diversify. They diversify when they have genuine uncertainty about which approach will work best, or when different assets provide different types of protection against different scenarios. For example, holding both stocks and bonds might make sense because they behave differently in different economic conditions. Stocks do better when growth is strong. Bonds do better when deflation threatens. If you're uncertain which scenario will unfold, holding both is rational hedging. You're acknowledging uncertainty and positioning to survive different outcomes. But holding many different assets just to say you're diversified, without understanding how they behave or why they're in your portfolio, is not risk management. It's just complexity without purpose. The principle is to think clearly about what risk you're managing and whether diversification actually addresses that risk. Sometimes it does. Sometimes concentration with deep understanding is better risk management. The answer depends on your knowledge and circumstances, not on following generic rules. Let's examine the psychological dimension of risk, which is where most investors fail regardless of their intellectual understanding. You can know intellectually that volatility isn't risk, that you should buy when others panic, that short-term fluctuations don't matter. But when your portfolio drops 30% and financial media is predicting catastrophe, your emotions will scream at you to sell. Managing this gap between intellectual understanding and emotional response is crucial for managing risk effectively. Great investors succeed not because they don't feel fear or anxiety, but because they've structured their approach so that emotions can't drive decisions. They use several techniques that are worth examining. First, they size positions so that even significant adverse movements don't create unbearable emotional pain. If a position is small enough that you can tolerate it going to zero without panic, you can hold through volatility rationally. If a position is so large that normal volatility creates panic, you're likely to make emotional decisions. Right-sizing positions for your emotional capacity is as important as sizing them for financial capacity. Second, they avoid looking at prices when they know volatility might trigger emotional responses. If you check your portfolio daily during a market crash, you're subjecting yourself to repeated emotional pain that serves no purpose. Great investors often deliberately avoid price information during volatile periods because they know it will only tempt them to make emotional decisions. Third, they write down their investment thesis and the conditions that would make them sell before they're in the grip of emotion. When fear hits, they consult their written analysis rather than making decisions in the moment. This gives them something rational to anchor to when emotions are intense. Fourth, they maintain adequate cash reserves so they're never forced to sell investments to meet living expenses. Being forced to sell during a downturn converts temporary volatility into permanent loss. Cash reserves prevent this and also create psychological freedom to hold positions through difficulties. Fifth, they cultivate relationships with rational people who can provide perspective during emotional moments. Having someone you trust who can remind you of long-term principles when you're panicking is valuable. Most people are surrounded by others who amplify panic during downturns, making emotional decisions more likely. The honest truth is that you will experience fear during market crashes. Your portfolio will drop significantly. You will doubt your decisions. You will be tempted to sell. These feelings are normal and universal. The difference between successful investors and unsuccessful ones is not that successful investors don't feel these emotions. It's that they have systems that prevent emotions from driving decisions. This is why thinking clearly about risk includes thinking about your psychological risk capacity. An investment might be financially sound, but psychologically unbearable for you. If you cannot sleep because you're worried about a position, it's the wrong position for you regardless of the mathematics. Psychological risk is real risk because it leads to emotional decisions that create permanent losses. Know yourself, know your emotional capacity, structure your investments within that capacity. This is not weakness. This is rational self-awareness and risk management. If you followed this discussion, you understand that thinking about risk the way great investors do is fundamentally different from conventional approaches. It's not about avoiding volatility or following generic diversification rules. It's about understanding what actually threatens your capital and goals, focusing on genuine risks while ignoring noise, maintaining margin of safety, taking good risks while avoiding bad risks, and matching your approach to your knowledge and capacity. This channel exists to explore these deeper principles of rational investing. If this approach resonates with you, I'd appreciate if you liked this video and subscribed for more content that focuses on timeless principles rather than market predictions or stock tips. Let me close with a synthesis of how great investors think about risk that you can take away and apply. Risk is not volatility or unfamiliarity or what scares you emotionally. Risk is the probability of permanent capital impairment or failure to achieve your financial goals. Everything else is noise. To manage risk effectively, focus on avoiding permanent loss rather than avoiding volatility. Volatility is the price you pay for superior long-term returns. Permanent loss is what actually destroys wealth. These are completely different, and confusing them leads to terrible decisions. Build margin of safety into everything you do. Don't just ask if something will work. Ask if you'll be okay if you're wrong. Structure your finances, your career, your investments so that errors and bad luck don't destroy you. This defensive positioning actually enables more aggressive long-term wealth building because you survive to compound another day. Distinguish carefully between good risks and bad risks. Good risks are ones you understand can survive if wrong, offer favorable odds, and are uncorrelated with your other risks. Bad risks are ones you don't understand, could destroy you, offer unfavorable odds, or concentrate your exposure. Take good risks. Avoid bad risks. Don't avoid risk. Generally, match your concentration and diversification to your knowledge and capacity. If you don't understand what you own, diversify broadly. If you do understand specific opportunities deeply, some concentration is rational. Don't follow generic rules. Think about your actual situation. Manage your psychology by sizing positions appropriately, controlling information exposure, having written guidelines, maintaining cash reserves, and surrounding yourself with rational perspectives. Your emotions will try to sabotage you during volatile periods. Have systems that prevent emotional decisions. Think about risk over appropriate time horizons. If you have decades, short-term volatility is irrelevant. If you need money next year, even small probability of loss might be unacceptable. Match your risk-taking to your actual timeline, not to arbitrary standards. The great investors who have built substantial wealth over lifetimes didn't avoid risk. They thought clearly about what risk actually is and structured their approach accordingly. They took significant risks in areas where they had edge and knowledge. They avoided risks that could lead to ruin. They maintained margin of safety. They survived inevitable setbacks and continued compounding. You can think about risk the same way. It requires rejecting conventional wisdom that confuses volatility with risk. It requires intellectual honesty about what you know and don't know. It requires emotional discipline during difficult periods. It requires patience to let good risks play out over appropriate time frames. But this thinking about risk is learnable and practicable. It doesn't require genius or special information. It requires clarity about what actually matters, discipline to focus on genuine risks while ignoring noise, and systems that enable rational decisions when emotions are intense. The world will continue to be volatile. Markets will fluctuate. Recessions will occur. Crises will emerge. None of this is going away. The question is whether you'll think about these events clearly, distinguishing between volatility and risk, or whether you'll confuse them and make decisions that permanently impair your capital. Great investors think differently about risk because they have learned through experience and reflection what actually matters. You can learn the same lessons without paying the full tuition of mistakes by thinking clearly from the start. Risk is not what hurts temporarily. Risk is what causes permanent damage. Focus your attention and your defenses accordingly. Build margin of safety. Take good risks. Avoid bad risks. Match your approach to your knowledge and capacity. Have systems that prevent emotional decisions. This is how great investors think about risk. This is how you can think about risk. The principles are clear. The application requires discipline. The rewards compound over a lifetime. Thank you for watching.